Let's go over the basics regarding common ways that people invest. Stocks and bonds are two of the most common forms of investment. A stock is a representation of ownership in a public company. They can be risky to purchase as their prices can change dramatically and unpredictably, but often the bigger the risk, the bigger the potential reward. There are two ways for stockholders to make money: dividends and capital gains. Dividends are profits paid out 4 times a year to all shareholders. The size of the dividend depends on the profit of the company. Capital gains are when a stockholder simply sells their stock for more than they originally paid for it. If the stockholder made a profit, it's a capital gain. If they lost money, it's a capital loss. A market for buying and selling stock is called a stock exchange. Brokerage firms are businesses that help stockholders trade stocks and sometimes even deal out stocks. These days, anyone can easily access the stock exchange on their phone through apps that offer brokerage services. A bond is essentially an IOU issued by a corporation or by some level of government. When you buy a bond, you are loaning money in return for a guaranteed payout at a later date. Bonds are usually a more stable investment than stocks. There are 3 components of bonds: their coupon rate, maturity date, and par value amount. The coupon rate is the interest rate that a bond issuer will pay to the bondholder. The time at which payment to a bondholder is due is called the bond's maturity. A bond's par value, assigned by whoever issues the bond, is the amount to be paid to the bondholder at maturity. In order for investment to take place, an economy first must have a financial system, which is the network of structures and mechanisms that allows the transfer of money between savers and borrowers. As we learned in the previous tutorial, when people save their money, they often are actually lending funds to others. Savers and borrowers may be linked